ETFs, exchange traded funds, are a alternative to mutual funds. They serve much the same purposes, ETFs, as do mutual funds. Here in this module, we're going to talk about ETFs and make comparisons to mutual funds. There is a very short reading associated with this module, ETFs versus mutual funds, that I suggest you read. ETFs and mutual funds differ in the way they are formed. The mutual funds that we see here, like the Vanguard 500, the Fidelity Magellan Fund, are open-ended funds. Once somebody gives money to the fund managers, they go out and invest it. ETFs do the opposite. They begin with the stocks, and then they sell shares in that portfolio of stocks. So it's exactly the opposite of an open-ended mutual fund. It begins with the stocks and then creates shares. ETFs have been used to mimic various indices, and probably the major one is the S&P 500. There are ETFs that mimic the S&P 500. They are very much like the Vanguard 500 fund, except that they are an ETF, exchange traded fund, rather than a mutual fund. ETFs work this way. There's a fund manager, a firm like Fidelity or Vanguard, and Fidelity and Vanguard do this, as well as many other firms. What they do is purchase stocks or get stocks or other assets, and they put these stocks together and they create a creation unit. What that creation unit is a share in those stocks. So we begin with the stocks, and then we create another share in those stocks. Institutional investors or others can then buy those creation units, which are a large number of those ETF shares, and then they could redeem those if they want to, but that doesn't happen very often. The process of being able to redeem it means that those prices of those shares equilibrate back to the underlying stock. But in general, what you do is trade the shares in the ETF. You have another share, just like you had a share in Monsanto. Now you have a share in an ETF, and that share you trade back and forth. Nothing happens to the underlying assets within the ETF, but you buy and sell the shares in the ETF. The institutional investors then sell to individuals and others the ETF. When they sell the share in the ETF, they earn a commission on it, and that's how they make money, by buying and selling ETFs. Any dividends on the underlying stock in the ETFs accrue to the shareholders. So if the Monsanto's in this share or is a share of this ETF or is a stock in the ETF, when Monsanto or any other company declares a dividend, it comes to that shareholder. That differs from a mutual fund. In general, in a mutual fund, those dividends are put back into the funds. They are reinvested into the mutual fund. There are two major advantages to ETFs, and the first is that ETFs can be traded intraday. And we're going to contrast this to the mutual funds on the next slide. Mutual funds are traded at the end of the day after the closing when an NAV has been calculated. ETFs, because it's a share or a stock, can be traded during the day, and you can use very complex orders around those ETFs like you would any sort of stock. The second advantage is tax efficiency. So mutual funds and ETFs, if the mutual fund manager buys a stock, then sells it for a higher price, that's a capital gain. In both cases, those capital gains go directly to the owner. So if you own a mutual fund, you will have capital gains on which you have to pay taxes. In an ETF, there's much less chance of a capital gain arising than in a mutual fund. So a mutual fund will have to sell stocks occasionally, maybe more often than you think, simply because the size of the mutual fund decreases. When that decrease happens, shares have to be sold so that the owners of the fund can be reimbursed. Well, that's created a tax event which will flow to the individual investor. Because under the ETF you're just trading shares, there's never a change in the underlying asset. So the underlying asset never changes because of needs to increase or decrease the mutual fund size. So tax efficiency, there's less of a chance of the individual tax owner or the shareholder of the ETF of having a tax event than under a mutual fund. This may help explain what's going on here. That the items, the lines that you see written there actually come from the Fidelity Contraband Prospectus that we looked at. The price to buy one share is its net asset value, NAV. Shares will be bought at the NAV next calculated after an order is received. So those NAVs are usually calculated at the closing of a business day, later in the afternoon. So if you send an order in for a mutual fund in the morning, you won't buy into that mutual fund till the end of the day. The price to sell one share is its NAV. Shares will be sold at the NAV next calculated after an order is received in the proper order. Same thing. It all happens at the end of the day. So in the next line, the fund is open for business every day the New York Stock Exchange is open. So NAVs are calculated at the end of every day of the New York Stock Exchange. NAV is calculated by taking the value of the stocks in the mutual fund, and dividing them by the number of shares. Again, you need to wait to the end of the day to make exchanges. That differs for an ETF. That advantage is probably not large for most investors, but it is nevertheless an advantage. That characteristic comes into play usually when markets are heading down quickly. So if we are having a 20% decline during a day, like we did in 2000 or 2008, you could potentially get out of it in an ETF, whereas you would have to wait to the end of the day in a mutual fund. That's probably not a major advantage for most individuals, but nevertheless, it still exists as an advantage. Summarize here. ETFs are an alternative to mutual funds. They differ in the way they are formed. ETFs begin with stock and then create a creation unit or a stock in the ETF. Mutual funds do it exactly the opposite. From an individual investor's perspective, ETFs and mutual funds are interchangeable. Probably the advantage that some investors would look at for ETFs are its tax efficiency. Again, you can buy and trade an ETF during the day, but that's probably a limited advantage to most individuals.